Mergers and acquisitions are a key part of business strategy. They allow companies to expand, increase their market presence, and access new technologies. The image shows two hands shaking, representing the coming together of companies through M&A. The dynamic swirls and futuristic cityscape convey the transformative and forward-looking nature of these transactions. As a speaker, I would emphasize the strategic importance of M&A and how it can drive business growth and innovation. The M&A landscape is influenced by a variety of market forces and economic indicators. We'll start by analyzing industry trends and potential acquisition targets. This involves understanding market growth, competition, and the regulatory environment. Economic factors like interest rates, inflation, and economic growth also impact M&A activity and valuations. It's crucial to identify competitors, their strategies, and potential threats to inform your own M&A decisions. Navigating legal and regulatory frameworks is especially important for cross-border transactions. Understanding these key dynamics will help us make more informed M&A decisions. M&A can provide companies access to new markets, customers, and distribution channels, allowing for market expansion and growth. Combining operations through M&A can lead to economies of scale and the elimination of redundant resources, resulting in significant cost savings. Acquiring valuable intellectual property, technology, and talent through M&A can drive innovation and strengthen a company's competitive position. M&A can help companies gain a competitive edge, improve their market share, and increase their bargaining power, ultimately strengthening their overall competitive position. Mergers and acquisitions, M&A, come in different forms, each with its own characteristics and strategic rationale. Horizontal M&A involves combining companies in the same industry and at the same stage of the value chain, like two rival airlines merging. Vertical M&A combines companies at different stages of the value chain, such as a manufacturer acquiring a distributor. Conglomerate M&A brings together companies in unrelated industries, for example, a tech company acquiring a food retailer. Acquisitions occur when one company takes over another, becoming the majority owner, like a large corporation acquiring a startup. Valuing a target company is critical for successful mergers and acquisitions. There are various valuation methodologies that can be used, each with their own strengths and limitations. Some common methods include discounted cash flow, DCF, comparable company analysis, and precedent transactions. The choice of methodology depends on factors like the industry, availability of financial data, and size of the transaction. It's important to carefully consider the pros and cons of each approach to arrive at a well-supported valuation. The goal is to determine a fair and justified price for the target company that aligns with the strategic objectives of the deal. The due diligence process is a critical step in any acquisition or investment, as it helps us thoroughly evaluate the target company. Let's go through the key areas of due diligence we'll be focusing on. Financial due diligence, reviewing the financial records, assessing profitability, and analyzing the overall financial health of the target. Legal due diligence, examining the target's contracts, licenses, and regulatory compliance to ensure their legal standing. Operational due diligence, evaluating the target's business operations, management team, and key processes. Market due diligence, assessing the target's market position, competitive landscape, and growth potential. ESG due diligence, examining the target's environmental impact, social responsibility, and corporate governance practices. Tax due diligence, reviewing the target's tax structure, liabilities, and potential tax implications of the acquisition. Technology due diligence, evaluating the target's technology infrastructure, cybersecurity, and data privacy practices. By thoroughly examining these areas, we can gain a comprehensive understanding of the target company and make an informed decision. M&A transactions are reviewed by antitrust agencies to ensure they don't harm competition. The Hart-Scott-Rodino Antitrust Improvements Act requires pre-merger notification to the DOJ and FTC. Public companies must adhere to securities laws that regulate disclosure and shareholder rights. M&A often involves employee transfers, triggering labor and employment law considerations. Tax implications for both buyer and seller, including capital gains, income tax, and other liabilities. Financing options are critical when considering an M&A transaction. Let's review the four main financing approaches companies can leverage. Debt financing allows companies to use their existing assets to fund acquisitions without diluting equity. Equity financing provides flexibility and can help attract strategic partners, but does dilute ownership. Hybrid financing combines debt and equity to optimize the financing structure. Seller financing, where the seller provides a portion of the purchase price, can be attractive to both buyers and sellers. The key focus of this presentation is synergy identification and realization, how we can find areas where combined operations can achieve efficiencies and cost savings, and then develop and execute plans to capture those synergies. We'll start by looking at the process of identifying potential synergies, analyzing where the combined strengths of the merged entities can lead to improved performance. Next, we'll discuss how to realize those synergies, creating detailed integration plans to seamlessly blend operations, systems, and cultures for a smooth transition. Finally, we'll explore the financial benefits that can be achieved by successfully capturing synergies, including revenue growth, cost reductions, and overall improved financial performance. Throughout the presentation, we'll provide concrete examples and case studies to illustrate these concepts in action. Integration planning and execution is a critical process for organizations undergoing mergers, acquisitions, or other major organizational changes. The first stage is pre-integration planning, where we identify potential areas of overlap, conflicts, and synergies between the merging entities. Establishing clear communication channels and defining roles and responsibilities is crucial during this stage. The second stage is integration execution, where we actually implement the integration plan. This involves merging systems, processes, and teams, while minimizing disruption to ongoing business operations. The final stage is post-integration evaluation, where we assess the effectiveness of the integration process. This helps us identify areas for improvement and ensure long-term success. Ongoing monitoring and adjustments may be necessary as the integration progresses. Understanding the culture of the target company is crucial. We need to identify their key values, beliefs, and behaviors through thorough research. Developing a comprehensive integration plan is essential to address any cultural differences and foster a cohesive environment between the two organizations. Open and transparent communication will be key to building trust and addressing any concerns related to the cultural changes that will come with the integration. Securing the full support and commitment of leadership from both companies is critical to promoting successful cultural alignment. Communication and transparency are key during mergers and acquisitions. Stakeholders need to be kept informed about the process, potential impacts, and the vision for the future. Active employee engagement fosters a sense of ownership and involvement. Encourage employees to ask questions, share their concerns, and contribute to the transition. Strong communication and commitment from leadership is essential for building trust and inspiring confidence. Implementing structured change management strategies, such as training programs, communication plans, and support networks, can help navigate the transition effectively. Integrating different corporate cultures can be challenging, as companies may have different values, communication styles, and work ethics. This can lead to resistance, conflict, and decreased morale among employees if not managed properly. Merging different systems and processes is complex and time-consuming, requiring careful planning and execution to avoid disruptions. Retaining key talent from both companies is essential to the success of the integration, which requires creating clear career paths, providing adequate compensation, and fostering a positive work environment. Effective communication throughout the integration process is critical to manage expectations, address concerns, and build trust among employees. Talent assessment is a crucial step to understand the skills and experience of key employees acquired during the merger or acquisition. This information is essential for creating an effective retention plan. A clear integration plan that addresses the concerns of employees, including their roles, responsibilities, and career development opportunities, is essential for successful talent retention. Merging two different corporate cultures can be challenging, but it's crucial for talent retention to create a unified culture that values the strengths of both companies. Ensuring that compensation and benefits packages are competitive and attractive is key to retaining key employees. This may involve adjustments to existing plans to align them with market standards. Digital transformation is reshaping the M&A landscape, driving deal activity in sectors like e-commerce, cloud computing, and AI. ESG factors are gaining prominence, influencing deal valuations, due diligence, and post-merger integration. Globalization continues to drive cross-border M&A, posing unique challenges around regulations, cultural differences, and currency fluctuations. Private equity firms are increasingly active in M&A, leveraging their expertise and financial resources to drive growth and value creation. Cross-border M&A presents unique challenges that require careful consideration. Understanding cultural differences is crucial for successful integration. This can impact negotiation styles, communication, and integration processes. Different jurisdictions have distinct legal and regulatory frameworks that must be navigated to ensure compliance and minimize risks. Currency fluctuations can significantly impact valuations and transaction costs, so hedging strategies should be implemented to mitigate currency risk. Effective communication and seamless integration are critical, requiring careful planning and cultural sensitivity. Distressed M&A and turnaround strategies are crucial for businesses facing financial difficulties. Early identification of distress is key. Look for signs like declining profitability, rising debt, and liquidity issues. Restructuring options for distressed M&A often involve operational changes, debt refinancing, or asset sales to improve stability. Experienced turnaround managers are essential to implement strategic changes, improve efficiency, and restore profitability. Distressed M&A negotiations require unique strategies to balance the interests of buyers, sellers, and creditors while maximizing value. Private equity firms are important players in the M&A landscape. They invest in companies and work with management to improve operations and increase the company's value. Private equity firms employ various M&A strategies like leveraged buyouts, acquisitions for growth, and carve-outs. The goal of these strategies is to enhance profitability and drive shareholder returns. Private equity's involvement can bring significant operational and financial expertise to help transform companies. Family businesses face unique challenges when it comes to succession planning, including transferring ownership and maintaining family harmony. Mergers and acquisitions can be a strategic tool for family businesses to preserve their legacy and ensure continuity for future generations. M&A can help family businesses unlock value, expand their reach, and achieve long-term growth and profitability. Family businesses can leverage M&A to form strategic partnerships, access new markets, and enhance their competitive advantage. Shareholder activism has become increasingly common in the M&A landscape. Activist investors can exert significant pressure on target companies, influencing their strategic decisions around mergers and acquisitions. Activist involvement can alter the terms of a deal, potentially driving higher valuations for shareholders. Activists often engage in legal battles to protect their interests and influence the outcome of M&A transactions. The presence of activist investors can add complexity to the negotiation dynamics between parties involved in a merger or acquisition. Antitrust laws are critical for maintaining a healthy, competitive market that benefits consumers. Government agencies carefully review mergers and acquisitions to ensure they don't create monopolies or reduce competition. Regulators evaluate factors like reduced competition, higher prices, and less innovation when deciding whether to approve or block a merger. A detailed market analysis is an important step to understand the competitive landscape and assess the potential for market power. The acquisition of a target company involves carefully evaluating their intellectual property, IP, portfolio, which includes patents, trademarks, copyrights, and trade secrets. Determining the value of the target's IP assets is crucial for deal negotiation and pricing. This valuation process helps ensure the acquisition is priced appropriately. Integrating the IP assets from both companies requires meticulous planning to avoid any potential infringement issues and maximize the combined value of the IP. Post-merger, it's vital to ensure adequate protection for the combined IP portfolio. This helps avoid legal disputes and maintain a strong competitive advantage for the new entity. M&A transactions require complex accounting adjustments and disclosures to accurately reflect the combined entity's financial position. Tax considerations play a crucial role in M&A deals, impacting the structure and overall financial impact. Conducting a thorough review of the target company's financial statements and tax records is essential for assessing potential liabilities and tax implications. Integrating the target company's accounting and tax systems with the acquirers can be challenging and require significant adjustments during the post-merger integration process. Thorough due diligence is crucial to uncover hidden risks and assess their impact on the deal's success. It's important to leave no stone unturned when identifying potential risks. This will help us make more informed decisions. We need to carefully analyze all aspects of the target company, including financial, operational, legal, and cultural factors. By uncovering potential risks upfront, we can develop better strategies to mitigate them and improve the chances of a successful merger or acquisition. Divestiture involves selling off part or all of a business to streamline operations, raise capital, or exit a non-core business. A carve-out is a specific type of divestiture where a subsidiary or division is separated from the parent company and listed on a stock exchange. These strategies require careful planning and execution, including market analysis, valuation, and deal structuring. Both divestitures and carve-outs have significant financial implications, including tax considerations, accounting adjustments, and potential debt restructuring. Mergers and acquisitions, M&A, transactions can raise important ethical considerations that must be carefully navigated. Ensuring fairness and transparency for all parties involved is crucial to building trust and maintaining integrity throughout the process. Maintaining confidentiality of sensitive information during due diligence and negotiations is essential to safeguarding data privacy and protecting stakeholders. Identifying and effectively managing potential conflicts of interest is key to preserving objectivity and avoiding bias in decision-making. Prioritizing employee well-being and protecting their rights during and after the transaction is critical to minimizing job losses and disruptions. Case studies provide real-world examples of successful and unsuccessful M&A transactions. They showcase the challenges, opportunities, and lessons learned that can inform our own M&A strategy. Best practices cover a wide range of areas: due diligence, valuation, integration, communication. Following proven best practices can help optimize outcomes and mitigate risks in our own M&A initiatives. The image on this slide depicts a diverse group of professionals collaborating on M&A, conveying a sense of optimism and teamwork. Investment banks possess deep financial expertise and market knowledge, which enables them to structure and execute complex M&A transactions. They provide strategic guidance, valuation analysis, due diligence oversight, and negotiation support throughout the M&A process, acting as trusted advisors. Investment banks have extensive networks and relationships with potential buyers and sellers, facilitating deal flow and matchmaking to connect the right parties. They can assist in securing financing, structuring debt, and navigating the complex world of M&A financing options, helping to facilitate transactions. Negotiations are a crucial part of business and personal interactions. Thorough preparation is key. Know your goals, understand the other side's needs, and have a plan. Effective communication is critical. Be clear, concise, and actively listen to build trust. Strategic decision-making is important. Analyze situations and make smart choices to achieve the best outcomes. Be creative and open-minded. Look for innovative solutions that address both parties' interests. The deal has now reached the closing stage, where we'll sign the final agreements and officially transfer ownership. After closing, the critical work of post-merger integration begins. This involves aligning our operations, systems, and cultures to ensure a smooth transition and capture the anticipated synergies. Communication with stakeholders will be key throughout this process, keeping them informed of progress and any necessary adjustments. We'll also closely monitor performance to track our progress and make any needed changes along the way. Successful post-closing integration is essential for realizing the full benefits of this transaction. It's a complex process, but one we're committed to executing effectively. M&A success is measured by analyzing strategic, financial, and operational outcomes. Key metrics include revenue growth, profitability, cost synergies, market share gains, and employee retention. Revenue growth looks at the increase in sales generated by the combined entity. Profitability examines improvements in net income and return on investment. Cost synergies capture the savings from eliminating redundancies and streamlining operations. Market share gains show the expansion of the combined entity's market presence. Employee retention minimizes turnover following the merger. Qualitative factors like cultural integration, stakeholder satisfaction, and long-term sustainability are also crucial to assess M&A success.